In today's class, we'll get into probable maximal loss, the definition of it, which we talked last class, is very similar to value at risk that you might have heard in your other classes. We'll do a couple of probable maximal loss examples. PML is another term for it. Get into a little bit into reinsurance, and then if we have time, we'll start risk securitization. So last class, we started this concept, probable maximal loss. It's an expected loss at some probability, some risk tolerance. So if your risk tolerance is 0.2% and your PML is $500 million, then what you're saying is 0.2% of the time, or 1 out of 500 years, you would expect to lose $500 million or more. And that or more is really important. You never expect to lose exactly $500 million. But it's that point on the distribution that comes in at the 0.2% probability. Or you could do it the inverse and say the insurance company expects to lose no more than 500 million 99.8% of the time. So how is it calculated? Usually insurance companies do what they call stochastic catastrophe models, stochastic CAT models. And they'll run a lot of scenarios. We're talking about things that happen very infrequently, but there's a huge skip in the tails of the distribution. So you go from $500 million losses to multi-billion dollar losses, and even though they're extremely rare, there's a jump in the tails. So insurance companies feel like they need many more simulations. The best known models out there are RMS and AIR. RMS and AIR are really good places to go if you're looking for some great ideas for a topic for a paper 2. Here's RMS site. I don't know what the RMS stands for, but they do have a lot of resources that you can go to. So you look under resources, you can go to publications, and you can just see what they're talking about right now. Investing in flood risk, management and defenses, cyber risk. Cyber risk is a big one. So, if you want to write a paper on cyber security and cyber risk, and you can see there's quite a few things that, quite a few topics. RMS, in, specifically related to California and earthquakes. There's another cyber risk exposure. They do life. You don't want to do life and health in this class. CAT models, RMS analytical services data sheet, etc., etc. They do have videos. In fact, we watched a couple of their videos on earthquakes and hurricanes. So this might give you some ideas of things to watch. I try to steal a few of their videos each year, just because there's some really good videos out there. What is catastrophe risk management? Closing the protection gap. Just a lot of topics. And then AIR is mainly focused. They start off mainly focused on hurricanes, but they do all these risks as well. So they have an insight button, articles, videos. They have videos as well. Managing your casualty risk with their product, introducing, there seems to be more focused on their actual products that they sell versus just topics, but I'm sure there's plenty of topics here. Wildfire risk has certainly been a big issue in California. Flood, crop hail model. You can get really specific here. Canada earthquake risk. I mean, my word, they're getting really specific here. But they also have articles and blogs. So, if you're interviewing for a job with an insurance company, this is the place to go and just kind of jump around and read, see what is the industry really focused on right now. What are their big items? You can see a lot on hurricane risk and modeling, and obviously this is the firm that does modeling, but you could certainly get some insights on that. And then Swiss Re, we're going to talk about reinsurance. Swiss Re is one of the big reinsurers in the world, and a really impressive firm. So they have a risk knowledge site. You can see all their topics that they have there. Mitigating climate risk. So obviously globalization, global warming is a huge issue for Swiss Re because they're insuring this, and so you see some of these topics that they're really focused in on. Getting it right when tackling global crisis. COVID-19 is a big issue that you'll see a lot of them talking about. So you'd almost think this is a global warming advocacy group, because so much of what Swiss Re focuses in on is on global warming and what that means for hurricanes, especially, and floods. So anyway, there's plenty of material here. Something else you'll see in some of these, I can't remember which of these firms, but the use of artificial intelligence for doing a better job of managing catastrophe risk and modeling and measurement. So there's a lot of really great topics. So artificial intelligence would not be a bad topic for paper 2 if you can figure out specifically how the property and casualty insurance industry is using AI to better understand risk and model risk. These companies like RMS and AIR, they're really good at modeling, not just something generic about the company, but actually modeling the company's exact book of business. I remember when they started, it was, how many houses do you have in this zip code? Now you send over your file of the actual addresses of what is insured. They know the exact house because, boy, everything's been mapped. They run simulations and provide expected losses, and those simulations include everything. So it can include additional living expenses. It can include what they call demand surge. That was a big issue with Hurricane Andrew, is when you have a large area that's been destroyed by a hurricane or a flood or whatever. It's the building costs are going to skyrocket because there's a shortage of construction workers, a shortage of materials. When you have to rebuild so many houses at once, it's going to be much more expensive to rebuild, and especially additional living expenses. When that many houses have been destroyed, it's going to take months to rebuild, and so people will have to stay in apartments much longer. Each new each new storm allows them to retool their models, recalibrate their models. So I mentioned Hurricane Andrew was a shock to the insurance industry. Not that it was this incredibly rare storm to happen, but even more so that it wasn't all that rare of a storm, and it caused so much damage. So all of the major catastrophe modeling firms had to step back and say, okay, wait, we're not capturing this. And as we talked earlier, demand surge was a huge part of Hurricane Andrew, that they did not realize. Demand surge and additional living expenses. When you have something that large hit such a large area, you need to increase those costs in your model. So now you would think each new model causes them to increase their losses. That you would think every time they get a new storm in, they realize, wow, we need to be more conservative. Losses are larger, but that's not true. They've had some storms where their models said the losses would be much greater than they actually were. So it goes both directions. They do learn. Every storm is a learning opportunity. They'll actually take an actual storm, and run it through their model and see what loss their model produced, and to compare that to the actual loss, and then they'll try to figure out where did their model get it wrong. So it's a learning process, and that's why over time they're getting better and better. But that's also why their hurricane models are more accurate than their earthquake models. They just have more data to work with. We're going to see how PML is actually calculated. We'll do the calculation here. So it's really just rank order them and find the one that equates to your particular risk tolerance. All right, let's try one. We're going to do an actual example problem, but just to let you know when you rank order all of those simulations, which one equates to your PML? Well, if you're running 100,000 simulations and you have a 0.2% risk tolerance, then you take, okay, what's 0.2% times 100,000? That's 200. So you want the 200 worst simulation, and that will be your 0.2. If you're doing 100,000, your 200 worst is not 99,800, it's 99,801. So you take your PML number, simulation number is 100,000 minus 0.002 times 100,000 plus 1. All right. So just make sure you've got that plus 1 there at the end. But let's actually work an actual example just so we can see how this is done in practice. So here's a firm. They have $2.5 billion in assets, $1.95 billion in liabilities, so their net worth is $550 million. So I don't know why I have it the year so late. Let's say it's 2021 or 2020. Their risk tolerance is 1%, and they ran 800 simulations. So what are we going to do? So you're going to take number of simulations minus the number of simulations times your risk tolerance plus 1. So here we have 800 minus 0.01 times 800, or I'm sorry, 800 times 0.01 plus 1. When you get that, you get simulation number 793. If you think about it, it's the 8th from the end. So number 800 is your worst simulation. So that's 1, then 99, 98, 97, 96, 95, 94, 93. So 793 is the 8th from the end. Why? Because we count number 800 as well. So simulation number 793. So we'll go down here. Here's some of the simulations that we had. So our very worst case was 850, but we're looking for the 8th from the end. 1, 2, 3, 4, 5, 6, 7, 8. 8 from the end, 793. So there's our PML. Our PML is 565 million. That's the actual PML. It's that particular one. All right, so how much capacity do they have? So our PML is 565. So what we're doing is somewhat we call a risk of ruin type of analysis, where we're saying, okay, we want to make sure if we have a catastrophe that it doesn't make us go out of business. So we have a 1% risk tolerance, so we want to have a 1% chance or less of going out of business. We have $550 million in net worth. Well, we have a 1% chance of losing 565. 565, so our PML is 565. Our capacity, how much risk we can take, is our net worth, because if we have a risk greater than that, we go out of business 1% of the time. So we're expected to go out of business more than 1% of the time, and we want it to be less than 1% of the time. So we're over our capacity. We'll go back to the class notes and we'll see what do you do if you're over the capacity. So we'll come back to that. But that's how you do the math. So you figure out which simulation you're interested in. 793 here. We just took 800 minus 8 plus 1. So that gave us 793. We then go on to our simulations. We find that simulation. That is our PML, 565, the one that associates with that simulation. We compare that 565 to our net worth, which is our capacity. If it's greater, then we have to do certain things. If it's less, we have to do certain things. All right, so there's PML question number 1. Let's try number 2. So here, $5.5 billion in assets, $3.9 billion in liabilities, and net worth of $1.55 billion. Now our risk tolerance again is 1%. Just like we did in the previous one, we'll take 900 minus 900 times 0.01 plus 1. Now I don't always do 1%, so make sure you look carefully. So that's me, 892. So we go down, we find our simulation equates to 892, and there it is right there. So our PML is 1106. Capacity is 1550. So in this case, our PML is less than we can stand. We can stand 1550. Our PML is less than that. Now, not every firm's capacity is net worth. At UTSA use a 0.2% probability, but after that 0.2%, they still wanted to have enough net worth to be a viable company. So their capacity was their net worth minus the amount of net worth they needed to be a viable company. So not every firm uses the risk of ruin. Some firms, it's like, we want to survive and be the only one surviving when it's all said and done. All right, so that tells you how to run the math. Math is pretty simple. Not really difficult to me. It's just one little formula and you go look at the numbers. So let's look, the more important thing might be, what do you actually do with these numbers once you get them? All right, so we compare the PML, that's what you expect to lose at that probability or more, to your capacity, how much can you afford to lose? If capacity equals your net worth, we call that risk of ruin analysis. It's a special case of value at risk or probable maximum loss, where you're making sure that you don't go out of business. If you're 1% is your risk tolerance, you don't want to risk going out of business more than 1% of the time. All right, so here we did the first scenario, 800 times 1% means you want the eighth from the end. The eighth from the end is not 792, it's 793. So our PML was 565. So we expect to lose 565 million or more 1% of the time, or 99% of the time we expect to lose no more than 565. Unfortunately, our net worth was 550. So in this case, our PML is greater than our capacity. Our PML is greater than net worth. So what do we need to do? So I've given you 3 broad categories of responses. The last one's really not a response, but it's something that companies do, so I want to just be aware of it. So the first thing you do is reduce your risk, reduce your PML. So you can sell less risky insurance. So maybe you stop selling along the coast in Florida or Texas and California. You go find those places that cause the most risk. I remember where I worked, they did an analysis and they discovered that 4% of their customers produced the overwhelming majority of their probable maximum loss. They could have gotten out of business with 4% of their customers, and it would have freed up a tremendous amount of PML. Now think about that. If you have insurance with State Farm or UTSA or Farmers, think about it. 4% of their customers is driving how much net worth they need. So, with State Farm, if they ran off 4% of their homeowners insurers, they could probably pay a $2,000–3,000 dividend to all of their remaining customers. UTSA, if they just said, you know what, we're not going to insure these high-risk areas in Florida and Texas and California on the coast, or in California in earthquake-prone areas, or we just stop doing earthquake altogether. If they did that, they could probably send every one of their customers a $2,000 to $3,000 check, because they're holding so much net worth for a small percentage of their customer base. We had these debates all the time at UTSA, the member versus the membership, the individual members versus the overall owners, policyholders who own the company. Whom do you serve? And UTSA's philosophy was they serve their customers wherever they decide to live. And it's that debate, is that really the best interest of the overall association? Why should you insure these few people who decide they want to live on the coast, have a nice beautiful house on the coast, they want to be insured even though there's a high probability it's going to be destroyed, and you're having to hold all this extra money for them? So there's one, you can just do an analysis of which customers are creating the bulk of your PML, and with homeowners insurers, it's amazing that it's a very small percentage. The next thing we'll talk about here is reinsurance. So Swiss Re is one of the biggest reinsurers out there. Munich Re, we talk about Gen Re when we're looking at Berkshire Hathaway. They sell insurance to insurance companies, especially for these major risks. And we'll look at kind of how a typical reinsurance plan looks. So that's one approach, and that costs money. You got to pay money for that, and reinsurance goes up and down price depending on what's going on with regulatory side and what's going on in the actual perceived risk, global warming, and all those kind of things. And then the last thing you do is risk securitization. It's something that actually UTSA was the first to do this, the inventor of this. We're going to actually do a math problem doing risk securitization. So we'll see how that works with real life numbers. So risk securitization it's somewhat like doing reinsurance, but not doing it with reinsurance companies. It's doing it with the capital markets. So we'll look at what catastrophe bonds are and how they work. So there's your first thing. You take enough of the PML off so that you're within your capacity. The next thing you can do is increase your capacity. So if you can't reduce the PML, increase the capacity. So you could just issue stock and increase your net worth overnight. You could raise your prices, raise your net income, make more money, but that's going to take a long time. You know, if you need to build up tens of millions of dollars in net worth, you're not going to do that by increasing your net income by $1 million. It's going to take too long, but you could do that. This is where Berkshire Hathaway talked about, you know, you want to make sure you have the assurance of a profit over time, maybe not every year, but over time, so that if you have a bad year, the others can make up for it. But if you try to do that, you say, we don't have enough capacity, we need to raise our prices. First of all, you have to get the regulators to allow you to raise your prices. Then you have competition, and you know, there's a lot of things going on. So that's a tough one. This tends to be the tougher way to get money. You know, issuing stock creates signal to your stockholders that maybe your stock's overvalued and that's why you're issuing stock, or there's all kinds of issues with that. So that's a little bit tougher one. So most firms tend to focus on reducing PML. Now some firms cheat. I call this one cheating. Say, you know what, we ran our model and we didn't like it. Remember when we talked about storm surge with State Farm? And they didn't like the initial results, so they had engineers rerun their models, and they got a much lower number. So there is some of that. You know, every time you run your models, your stochastic models, you'll get a different PML. It may be slightly different. We'll talk about how they actually check their models to see how confident they are in them. But they might change their assumptions and say, you know, we're being too conservative. So let's not be so conservative, or maybe being too conservative on additional living expenses or on demand surge. Well, the model's going to tell you whatever the model has input into it. It's possible the models are too conservative. History has shown that they tend to understate risk rather than overstate. Not every time. There's been some storms where they've actually overstated the risk. But generally, over time, the models have been shown to understate risk. So you might want to be conservative anyway to start with. But you could do that. But that's just cheating. I mean, the risk is what it is. Changing a model doesn't change the risk. So you want to be as accurate, obviously, as you can be in the model. But at the same time, you don't want to change the result of the model just because you're not meeting your standards. Otherwise, there's no risk management going on. You want both of these numbers to be honest numbers, that you're really assessing the firm. Now, if you build more cushion, when do you know you've built enough cushion? And this is the debate we have with rating agencies. Rating agencies will tend to tell you how much cushion you need for a particular credit rating. If you want to be a single A-rated company, they're going to tell you, oh, you need $700 million in net worth, or 800. So they'll tend to dictate how much your capacity needs to be. or they're going to dictate what your risk tolerance is. So if you say, hey, we want to be single A rated, that's maybe going to equate to a 0.5% risk tolerance. That's then going to influence your PML models and then influence how much capacity you have. Because if you don't have this capacity for the PML, the rating agencies will downgrade you. So they have a lot of power in this. They have their own models. I was somewhat privy to a couple of their models. In fact, with Moody's, they actually called me to run their newest model through the database we had of all the insurance companies. So I had some pretty cool access to early models and how they view this analysis. And we did some pretty cool things. Having access to the financials of all the insurance companies allows you to do some pretty interesting analysis, even on PML. There's ways I could do PML where I adjusted for our book of business to other companies to try to figure out what their PML was. So there's things you can do, really cool analysis. And so rating agencies do that as well. They look at the entire industry and they're trying to figure out how much net worth a company needs to cover for the risks that they have. And so PML is a big part of that. All right, so if you don't have enough, and this is probably what I'm going to give you on the exam, is a firm that doesn't have enough, their PML is greater than their capacity. But what if we have a firm like this second example? Their PML is 1106. They have plenty of capacity. What can they do? Well, they could take on more risk. They could sell riskier products if they wanted to. They say, why in the world would you do that? Well, maybe the riskier products, maybe there was just a recent major catastrophe and your firm wasn't in that business, but because of that major catastrophe, the pricing side of that has really been freed up. Regulators are allowing you to price much more aggressively. So maybe it's a business where right now you can make money on it. It's just like Berkshire Hathaway said, hey, if you can make money, you can charge the right price, you're being compensated for your risk, then maybe you take it. So maybe a PML's just happened. You're not in that business, because of the PML, you now can price this product really favorably. And so you do that and you get into that business. You can reduce your reinsurance. Reinsurance is expensive. Risk securitization is expensive. So maybe you cut back on those and save some money because they're only going to protect you in a real extreme event. And if you have plenty of capacity, maybe you keep that, and over next 10, 15, 20 years, you actually come out way ahead by not spending money on reinsurance to cover risks that just are pretty unlikely to happen in the next 20 years. You can reduce your capacity, so you could pay bigger dividends. You could buy some stock back. You could cut your prices to be more competitive and lower your net income. Or you can do just the opposite on your models. You could say, you know what? We don't trust these models. It says we have plenty of capacity, but you know what? Reconfigure models and make them more conservative. So those are approaches. It's unlikely I'll give you a scenario where they have too much capacity versus their PML, but these very similar to what it's just the opposite of what we said up here. All right, so how do you know if you have a good model or not? Let's say you're running 500 simulations. How do you know if 500 is the right number? Should you be running 1,000 or 10,000 or 1,000,000? I remember at UTSA we got into discussion on running 1,000,000 simulations. So the key is this term convergence. So you run the model multiple times, you determine your PML. If you're only running 500 simulations and you see your PML jumping all over the place, maybe it's $500 million one time and $700 million the next time, then $400 million, it's jumping all around. If you get those kind of jumps in your PML, then you're not running enough simulations. So you need to find it so that your PML starts converging on a number. It doesn't be exactly, it will never be the exact same number 2 or 3 runs in a row. It's always going to be a slightly different number. But you want to make sure it's starting to converge on 550 million. So maybe it was 540, then 555, 545, but it's staying right within a pretty tight range. Then you know you've run enough simulations. So if you run 1,000 and it doesn't do that, and then you run 10,000, you've got convergence, then 10,000 is good. Now you say, well, why not just run 1,000,000? Well, it's extremely time consuming, takes a lot of computer time. And so, if 10,000 is going to give you a pretty accurate number, then run 10,000, don't run 1,000,000. It's just very time consuming to run these models. So if it's jumping around, you need more simulations. You don't have convergence. So you want to be parsimonious. You want to make sure you run enough simulations so that you have some confidence in what the number is, that it's not jumping around, but you don't want to run too many because it's just costly. So one solution is risk securitization. We'll do risk securitization last. I want to come back to that. We'll definitely talk about it. You'll see the examples there. It's a pretty cool process. We probably won't do a problem today, a full problem today. We'll see. We might have time actually to do a full problem, but we'll talk about securitization. So we'll come back to this. Securitization is a pretty cool concept. It's where financial engineering and the financial markets has gotten pretty sophisticated, coming up with new ways of managing risk, using the full strength and massive size of the capital markets. But before we get into securitization, let's go back to the old traditional way insurance companies manage these risks, and that's reinsurance. So insurance companies buy insurance from other insurance companies against key risks. Now, on the life insurance side, almost everybody does reinsurance. So, UTSA will assume other people's risk and they'll cede their risk, and those are key terms. You can assume risk or you can cede risk. If you assume risk, you're the reinsurer for the other company. If you cede risk, you're buying insurance from an insurance company. So assuming risk, you become the reinsurance company. If you cede risk, you're going to a reinsurer to give them risks. So on the life insurance side, life insurance companies tend to do both assume and cede. On the property casualty side, there's a particular part of the industry that does the reinsurance. So there's an entire, like Swiss Re, Munich Re, Gen Re. You see the word Re after it. That's definitely on the property and casualty side. Now there are some companies that specialize in reinsurance on the life side, and you'll definitely see that a few of those companies. But on the property and casualty side, very, very specialized, like Swiss Re, very, very specialized companies. That's why, if I were an actuary, I think Swiss Re would be my career ambition. Just looks like a really cool firm to work for. Employers Re is a good example one. That's the reinsurer that General Electric owned and caused them, they've really done badly in their financial services side. I think they've been trying to sell off Employers Re, but those are the big ones. Swiss Re, Gen Re, Munich Re, Employers Re are the big ones we generally hear of. So it's a very concentrated industry. There's very, very few of these big companies, and I think there's even some discussion about Munich Re being taken over and being merged in with another large reinsurer. So it's tough. At UTSA, we really struggle with there just were not enough reinsurance companies out there and just too concentrated in a few companies. So reinsurance, it is insurance, but it's insurance with a massive deductible. The deductible could be $1 billion, $2 billion, something like that. And the deductible for reinsurance is known as the attachment point. So you just have to know that attachment point. So if the attachment point is $1.5 billion, the reinsurer will only cover losses above $1.5 billion. And we talked about rate on line earlier. So if the reinsurer covers $1 billion in losses above $1.5 billion, so you have $1 billion in coverage, and you're paying $150 million for that, you take what you pay divided by the coverage you get, and that gives you that rate on line. And that's a quick way to look. Now, obviously, if it's only covering losses above $1.5 billion, that 15% might be pretty expensive because 1.5 billion might be an extremely rare event, but it still gives you some sense when you're comparing one program versus another. What are you paying? You might have another policy that covers $500 million above 250. And so what you have is different layers for different risks. So you might have hurricane layers, earthquake layers, you may have specific state layers. So Hawaii might have its own reinsurance program, and then you may have another one that's California, another one that's Texas, another one that's Florida. You may have a national one. So in some places you might have a reinsurance program, but Hawaii has their own special state-run pool. And so when you're looking at your reinsurance in Hawaii, you have to work around whatever the state is providing. So it can get quite complicated state by state types of risk. So different territories, different risk. So most firms have a schematic that shows the sources and coverages for their different reinsurance. I've not been able to find one that looked just like the ones I was used to seeing where I work. I'll show you a couple of these that, to me, it's hard for me to figure out exactly what they're saying because I don't know their specific program, and obviously this is very proprietary information. So it's, you're not going to get precise understanding. So I can't give you a grade. If I could show you the ones I used to see where I worked, boy, I understood those because I knew our programs. It's tough for me to show you in detail how it works, but I'll give you some examples so you can at least see this layering effect. So the schematic shows the sources of coverage. So how do you know what is optimal? This is the question we ask. How do you know you bought the right amount of reinsurance? So your goal is, and you don't know, it depends on the scenario, right? You might have one set of layers in Hawaii and one set of layers of reinsurance in Florida. Well, it depends on what hit. Was it a Florida event or was it a Hawaii event? And so what you do is you run your catastrophe models with different types of reinsurance programs, and what you're trying to do is find the reinsurance program that for its cost has the biggest impact on reducing the PML. So you can have one that's extremely expensive but eliminates a lot of risk. You might have one that's not very cheap, but it's going to really, you have a good chance of going out of business. So you save a lot of money, but your chances of going out of business are really high. So you're trying to balance the two. The actuaries where I worked, their goal was, hey, let's find the best mix here between the cost of the program, but the goal was reduce that PML. And the PML is just one collection of storms, so you can't just look at the PML that you ran last time because that's just one particular scenario. It's two big hurricanes in Florida. And so you can't run your reinsurance program to protect that one PML because the next time you run your stochastic model, your PML might be about the same dollar amount, but this time it might be hurricanes in Hawaii or hurricanes in Texas. And so you can't manage just the PML. So what you have to do is you set up your reinsurance program, different scenarios, you run your entire PML model, and you're looking at what has the most impact when you look at it. And it's a statistical exercise, so you never know for sure that it's going to give you the right answer. But it's statistical. On average, here's the extra costs, here's the PML reduction. So now, probable maximum loss is what we just calculated. Some firms also talk about the maximum probable loss. And essentially that is, at some reasonable case, what is your true worst case scenario? It's almost like taking scenario and then destroying every property. So if there's some probability you have really massive loss, it just takes everything to the ground. Versus probable maximum loss, it's saying, well, you have some buildings that there's still something there that you can cover. So we won't use maximum probable loss. It's a little bit stranger kind of definition. When you look at these numbers, you tend to look, it can be on a per occurrence basis, but what a lot of firms are looking at, what's your aggregate number on an annual basis? So at UTSA, we had PMO models where we ran them without reinsurance and ran them with reinsurance. And it's very interesting looking at the PML with and without reinsurance, because they're usually radically different events. Without reinsurance, a Florida hurricane event might be your problem excess loss. Then when you put reinsurance in there, that your reinsurance cuts that Florida loss dramatically, and then suddenly your PML is an earthquake in California where you don't have as good of reinsurance. All right, so let me show you a couple of these reinsurance programs I just got off the internet, so that's why they're not too trustworthy. I just pulled them off of Google. So here's one, and you see these different layers. So this is the way you normally see it. So usually you have retention at the bottom. What this firm's saying, okay, anything up to this amount. This is a really small firm. Anything up to 9 million, we cover that in total. From 9 million to 30 million. See, I can't even say 9 million. So that's a small number. 9 million to 30 million. We have a small pool that covers certain things. We have a lower pool, another pool that covers, and they show you who the company is. Then they pick up some, so the blue is what they're covering. And then they have these other layers, and they have these core insurance layers. And here you see they have oil pollution, and they have protection and indemnity. So 2 different risks. So their maximum oil pollution is $1 billion. That might be just, that means that anything over $1 billion they're totally paying for, or it might just mean $1 billion is the most they're ever on the hook on. Who knows? Exactly how that structured. And then for protection and indemnity, you can see they have several layers. Each one of these will have different coverages. So it's just, it's hard to say exactly what this is, because I can't tell you exactly what's in each one of these layers and what they're covering. But reinsurance, these different color, and they don't give us this color scheme here either to tell you what this is. So it's hard to get off the internet detailed. Here's one for Allstate. This was their 2012 nationwide per occurrence excess catastrophe reinsurance. So this is a per occurrence. And so it just shows you they retained $500 million. And then after $500 million, they've got $250 million. Plus they have some reinstatements over here. And then after that, they have different programs. And again, I can't explain exactly what they're saying here because there's not enough detail here. And in fact, even USAs, if I were to show you USAs, you couldn't really explain it looking at the chart without the color coding and telling you. So each one of these might be a different reinsurance company, it might be some securitization, might be a co-insurance program. There's just different programs. And if an event has happened, the next event might be very differently covered. And that's where they talk about reinstatement. If they have an event, are they still covered? Or is this a one occurrence type of coverage? So it gets quite complicated. You can see how complicated the math would be to try to figure out what is optimal, because this is just one particular program. It might be one particular state. They say this is nationwide, but nationwide it's going to vary by state, because Texas has a wind pool, Florida has a wind pool, California has an earthquake pool, Hawaii has a wind pool. So there's some of these programs, and I remember at UTSA you'd have a program where it says this is the Hawaii wind pool, and you say, well, so we've got coverage from $1 billion to $2.2 billion, but that coverage only applies if the hurricane happens in Hawaii. Otherwise, it doesn't cover. So it gets quite complex. There's reinsurance. Now, there's a special type of reinsurance called securitization. So let's start off with what is securitization. You could look this up on Google or some other website. Asset securitization is we take something that's not a security, something that's very illiquid, and you make it a security. So a good example of that is what we call asset-backed securities, mortgage-backed securities. So you have something that's not publicly traded. So let's say Frost Bank lends you money to buy a house. That mortgage if I were to call up Frost and say, hey, you have some mortgages, I want to buy them from you, Frost really wouldn't know what to do with that. But what Frost can do is they can take all of the mortgages, all the loans that they've made, and they can place them in a trust. The trust will then go out to the capital markets and borrow money against those assets, and then they'll repay that debt by simply passing through the cash flows from their borrowers. So as you pay off your mortgage, that trust will take your payments on the mortgage and they'll send them to the lenders, whoever loaned money to the trust. So that's why they're also known as pass-through securities, mortgage pass-through securities, mortgage-backed securities. Frost Bank, the originating bank, they earn a fee for setting all this up. So these are known as, this is the MBS market, the mortgage-backed security market. So yeah, Frost Bank gets an originating bank fee. They can do it not just for the mortgages, but home equity loans. If banks even do home equity loans anymore, you can take all your credit card loans and put them in a trust. Auto loans, you can do your own bank loans where you loan money to businesses. Those are called CDOs and CLOs, collateralized debt obligations, collateralized leverage obligations. So banks do a lot of this. In fact, you might have heard the term shadow banking, where it looks like banks are doing a lot of the lending in the country, but essentially what banks are doing is they're originating the loans, but then they're putting their loans into a trust, and it's really Wall Street that's loaning them money. The banks get these loans off their books as quickly as possible, and so yeah, it's like an entire other banking world. It's actually the huge bond market in the United States and globally that's providing money for loans for houses and cars and credit cards. So that's on the asset side. So would it be possible to do something like this on the liability side? And you say, well, that's crazy. Who would want to buy a liability? Well, it's happened. And if you actually look up catastrophe bonds on Wikipedia, any place like that, you'll probably see, in a lot of places I've seen it, you'll actually see USA's name. I know in the famous Bozy book on fixed income, the Handbook of Fixed Income, it used to be, I don't know if it's still in there, but in some older editions, when you went to the catastrophe bond chapter, you would see USA's name there as the first insurance company to do a catastrophe bond. And I remember when USA did that, the chief actuary that was responsible for that, really nice guy, really brilliant guy. Boy, it was pretty exciting to be part of something that new. So risk securitization, you're actually securitizing a liability. So why in the world would someone want to buy a liability from you? And it's specifically focused on catastrophes, so that's why we call them cat bonds. I accidentally used the word cat bonds when I went to a financial conference. The PhD who was running the conference, real famous guy, writes a lot of articles, very well known in the investment worlds, and I went up and used the term cat bonds with him, and he had no idea what I was talking about. I felt so stupid. But catastrophe bonds, cat bonds. So you create the trust that borrows money, and what the lenders are told is, hey, we'll give you a really high return on these cat bonds. You can get a really, really great return, a better return you can get anywhere else. However, if there's a major catastrophe that exceeds our deductible, exceeds the attachment point, then you as a bondholder are not going to make the return you made. So maybe the catastrophe is a 1% event. So these people in this trust who loan money to the trust, they've got a 99% chance of making a really, really good return on their cat bonds. And they got a 1% chance of losing money and even losing 100%. But the attachment point is extremely, extremely high. Very high deductible, so there's very low probability it's going to happen. So losses below the attachment point, nothing's paid out, and the cat bond facility, they make the return. So we need to look at some examples of cat bonds and see how they actually work, so that we can get a little bit of practice with these. So let's work through one. You do have a YouTube that shows you how to do this. So what I'm doing here is going to be a replication of that one. What I'll try to do for the first exam is I'll give you a cat bond from the last exam that I gave in this class and let you practice that, so you get an extra problem to practice, and then we'll work that in the class somehow. So we'll get a little more practice. I wrote this problem back when Jeremy Lin was making the headlines in the NBA, so sometimes I like to steal a name from the headlines. So the Lin Company issued $2.5 billion of 5-year catastrophe bonds. They were paying 4.8%. You may not think that's a great rate, but at the time I did this, that was a really good rate for a 5-year bond. Treasuries at the time were 5-year treasuries at 2%. So it's a time when interest rates were much higher than today, but still 4.8 was a good rate. They have an attachment point of $900 million. That's going to be pretty critical. So the key things is how much do they issue? So the $2.5 billion means they actually borrowed $2.5 billion. So this trust goes out there and they borrow $2.5 billion. And they borrow by issuing a 5-year bond that has a coupon rate of 4.8. So they're promising to pay these people 4.8% for 5 years. A zero coupon treasury currently yields 2%. Now, why am I doing zero coupon bonds? You'll see I'm just simplifying it. And then the attachment point is 900 million. So that's all the data we need to be able to do this problem. So 1, 2, 3, 4, 5 pieces of data. 2.5 billion, 5 as far as time, 4.8%, 2%, and 900 million. So what you have to do in this problem is tell me, what did the bondholders get? The people loaning the $2.5 billion. Now, let me just make it really clear here. This is not quite, the way I have it set up here is not quite the way it works. So Lin Company is setting up a catastrophe bond, but really what Lin Company is doing is they're going to set up a trust, a separate company. They're called special purpose entities, SPEs. Lin Company is going to set up this company, and this company is going to be an insurance company. It's an insurance company, only has one customer, and that's Lin Company. So Lin Company is actually not going to issue cat bonds. If Lin Company is an insurance company like UTSA, what Lin Company is going to do is they're just going to go to this SPE that they set up, and they're going to buy reinsurance. It's going to be this special purpose entity that's actually going to issue the catastrophe bonds. And that was key at UTSA. So UTSA had a special purpose entity. I can't even remember the name of it, but a special purpose entity. It only had one customer, UTSA, and UTSA would buy reinsurance from it. But as far as the bond market was concerned, UTSA wasn't involved. There was a separate company, I think they called it ResRe or something, but it's a separate company that issued bonds to the market. They took that bond and they used that to help fund reinsurance to UTSA. And so if you ask UTSA, do you do cat bonds? They'll say, no, we don't do cat bonds at all. We just buy reinsurance from this company called ResRe, but we don't issue cat bonds. And so I'm being a little sloppy here saying that the Lin Company is actually doing this catastrophe bonds. They're probably doing it through a separate entity. And there was some debate at UTSA whether these SPEs should be consolidated in with UTSA, and UTSA argued strongly that no, this is a separate entity. This is not part of our business. And I think they won that argument with the auditors, but that was a debate, especially after Enron and what Enron was doing as special purpose entities. It made the auditors a little bit nervous, but these really are separate entities. They're set up as separate entities. And if anything happens to them, the creditors are going to have to go after those entities. They can't come back to Lin. So just realize I'm being a little sloppy on the setup here. So there's actually another entity involved in between all of this. So what we're going to do is say, hey, how did the bondholders do? And then we want to ask, how did Lin do? All right. So the first question we ask, well, what did they lose We'll have to have a $550 million catastrophe. Well, that was pretty straightforward. The attachment point's $900 million. These bondholders, they don't care. $550 million, that's below the attachment point. If that happens, they're going to make their 4.8%. So that's really straightforward. There's nothing there. What if it's $1 billion? Well, if it's $1 billion, it's slightly above the attachment point. So this bond, this cat bond, is going to cover $100 million of that loss. And then Lynn will have to cover the other 900. What if the loss was $4 billion? Well, if it's $4 billion, that's well above the $900 million. So the bondholders are probably going to lose their entire $2.5 billion. All of that is going to go to Lynn. And you can see when I was showing you those reinsurance schedules, 900 is what Lynn is retaining. Now they may have other reinsurance some other place, but they're retaining 900 million. Above 900, this catastrophe bond is going to cover them, but only up to $2.5 billion. They can't get anything more than $2.5 billion because that's all the bondholders have provided. So the max coverage they can get is $2.5 billion. So essentially, Lynn Company is retaining risk up to 900 million, and between 900 million up to $3.4 billion, this reinsurance mechanism that's set up as a catastrophe bond is going to cover that. So I'll go through it quickly and then we'll do it again next class, just to kind of set it up. So first question we ask is, how do we make sure these bondholders are going to get their 4.8% return? You notice I say that the CAT happens immediately after the bond is issued. So this is probably more than likely earthquake coverage, because we're not going to issue a bond today and tomorrow a hurricane wipes out the company, because you can see hurricanes coming many days before. So probably an earthquake, something that can happen just immediately. So you issue the bond and then the next day there's a massive earthquake. So the question is, these people have loaned us $2.5 billion and we have to give them a 4.8% return. So how much money do we need in 5 years so that they have a 4.8% return? So we take $2.5 billion, I expanded it out to millions, times 1 plus 0.048 raised to the 5th power. So they need to have, in that trust, they need to have $3,160,000,000, $430,000 in that trust. Now what can they do? Well, the trust does not want to take investment risks. They want to be very, very low risk, and the lowest risk thing they can do is a treasury security. So if they buy a treasury security, how much do they need to invest today so that they will have $3.16 billion? Well, you take the ending value that they need and divide it by the rate they're given, they're going to receive 1 plus 2% to the 5th. Today they need $2,862,500,000. All right? So they need to invest this today at 2% so that in 5 years they have enough money that these people will end up with a 4.8% return. Now I'm using a zero coupon treasury, and I'm keeping it somewhat simple because there's some interest rate risk of reinvesting coupons off the debt and all that. So I'm just keeping things simple. All that things I'm doing simple is not really watering down that much. It still works just like this. It's a little more complicated to manage. So the question is, what is Lynn going to have to pay in a premium? So Lynn is, it's almost easier not to think that Lynn's issuing the cat bonds, but some trust that Lynn set up is issuing the cash bonds. And now Lynn is going to buy this insurance policy. It covers $2.5 billion in losses that are above $900 million. How much of a premium will Lynn have to pay? Well, the bondholders are sending you $2.5 billion. You need $2,862,50. So Lynn is going to have to pay a premium of $362,500,000. That is the amount the company needs to invest today minus what it will receive today. Lynn will have to provide the $362 million. All right. So let this sink in. I'll do it again next class so you can kind of get used to it, and then we'll start answering questions. What happens if these different things happen? So we'll start we'll do these again just to give you a good chance to let it sink in, and then we'll go through the actual calculations down below.